Good morning. It is July 29th. It is 11 o'clock, Saturday morning. My name is Ken Crotty, and I want to thank you for taking the time to be with me today. We are going to learn about qualified opportunity zones. Like anything, we always use acronyms, so it's shortened to QOZs. And since there's a lot of acronyms that we're going to be using, we have the Qualified Opportunity Fund, which is a QOF. Maybe you have something related to the business, so it's a QOZB. So that's why we decided calling it Let's Learn About ABCs. So before we get into that, let me just get onto the screen here so I can move the slides. There we go. If you would like 1 hour of CPE credit, here's the registration information. And I believe it's all self-explanatory. It's the same as what we've always had before, so I'm sure everyone's familiar with it. The wrong way of doing this, you will not be able to get CPE credit. And again, this is just letting you know the correct way of doing it going forward so that you can be in a situation in the future to get the credit that you want. All right, currently does not qualify for continuing if you did not sign up. So then again, this is the information just so that you have it. If you are new to this, it's the way to get you credit in the future. All right, so I think we can skip those for now. With respect to asking a question, if you do click on that red arrow on the top on the step 1, and then the questions, the drop arrow down below that, if you want to go ahead and send those, I will do my best to answer them. Like always, if they're too hard or I don't know them, I will do my best to completely ignore them. But hopefully we'll be able to get you some answers if you do want to send questions over. We do have a series of free webinars available, and that's here at the YouTube channel. So we want to make sure you're aware of that resource, help you with hopefully with some questions that you might have. Some of them are done by us, others are done by the guest speakers that are professionals in the field that, with the topic of the webinar. So hopefully they're helpful for a lot of people. All right, so again, we're going to be talking about qualified opportunity zones. And so before we get into that, generally one quick note is, obviously Alan's not here. He's on vacation over in Great Britain. So sadly today you're not going to see any puppets. You're going to hear from one dummy. You're not going to have multiples. And we thought since, Alan's in Great Britain, it'd be good to have jokes with a British theme. So we'll start off with, what do you call London without electricity? So not a polling question, but just to see if you're actually awake and listening. What do you call London without electricity? And the answer is Lundoff. So it's a great joke. We're off to a good start. All right, so looking at qualified opportunity zones, just generally, the idea behind this is that if you are a taxpayer or your client's a taxpayer, and we'll get into the definition of a taxpayer. It's not just an individual. It can include a trust estate, businesses as well. So if the taxpayer has an eligible gain, which generally can be thought of as a capital gain. So let's make it easy. I'm an individual, I sell stock, I now have a capital gain. Typically, I would need to pay tax on that capital gain with my 2023 income tax return. One way to avoid that or defer that recognition of gain is if I take my eligible gain and I invest that gain in a qualified opportunity fund, then assuming I do it correctly, I do not have to pay my capital gain tax in 2023. Instead, that gain is deferred until 2026, at which point it would be recognized then in that tax year. So you get the benefit of tax deferral. In addition to that, the other benefits that you get are you get an increase in your basis between 5 and 7 years if you have that holding period. And then if you've held the property for a sufficient period of 10 years, then when you sell that property, any gain on the investment is disregarded. So it's a great tax planning mechanism for individuals. So again, we're going to go through what an eligible gain is and the taxpayers, the timing, reporting, and the amount of investment. As a general rule, you have 180 days from the actual event causing the gain to make the investment. That 180-day period is a little bit different, and we'll get into the details if you're dealing with an S corporation or a partnership, which is a pass-through entity, as opposed to an individual taxpayer. But if you're just dealing with a single taxpayer, you generally have 180 days after the event to make the investment. Like we talked about, the recognition of previously deferred gain, that's going to occur in 2026. We'll go over the detail of that. The base rule is that you recognize the gain that was deferred, the lesser of either that or whatever your current value, fair market value of your investment is. In addition, we're going to talk about qualified opportunity funds and what requirements have to be met for a fund to qualify, the 90% test, which goes towards the asset test. It's kind of similar to the tests that we have in a charitable situation where you're dealing with a private foundation or a private operating foundation and making sure that the asset test is satisfied. Qualified opportunity zone properties, we're going to talk about that as far as what areas are eligible for this investment. And then when we talk about QOZ BPS, and again, we're going into the ABC world. So the QOZ PPS is a qualified opportunity zone business property. So that's the actual property that's owned by your qualified opportunity fund if it is conducting the business directly. Or the qualified opportunity fund could indirectly own ownership interest in another entity that conducts the business. And that's where we get to the QOZ stock or the QOZ partnership interests. Qualified opportunity zone business, that's the actual business that's being conducted in the qualified opportunity zone. And the essence of the rule is that the business needs to either improve the lives of the residents in the qualified opportunity zone or provide economic benefit, by providing jobs, etc. So we'll talk about that. We'll go into detail and do an example at the end about the tax benefits, the increase in basis that you get in the investment and the other items, and the ability to possibly sell the investment tax-free with the disposition of the investment. And there we're talking about recognition events. And then finally, we'll just kind of wrap it up quickly. So hopefully you'll stick with me through this. And before we get to that, I want to do one more joke. So what did America say to Britain when it fell over? And the answer is UK. So no one said they were going to be great jokes. Really, no one even said they were going to be good jokes, but hopefully they're keeping you somewhat entertained. All right, so the general life cycle of what we're looking at for a taxpayer is that the taxpayer sells the asset, as you see at the top of the screen. That's going to generate a capital gain. The taxpayer then has 180 days after the date to invest that into a qualified opportunity fund. And again, here I'm just kind of showing an individual taxpayer. So 180 days after I sell my Google stock, generating a capital gains, I can invest that into a qualified opportunity fund. If I hold that investment for 5 years, then I'm able to exclude 10% of the original deferred gain. My basis goes up to that. If I hold it for 7 years, then I'm able to get an additional basis of 5%, allowing me to exclude up to 15% of my original gain. And then finally, for 10 years, if I hold it for 10 years, when I sell the investment, I'm able to exclude all of the growth and the gain on that investment. So if you're looking at making an investment and holding it for a 10-year period at a minimum, that's where you're going to get the maximum benefit here for your qualified opportunity fund investment, assuming that the investment goes up, obviously, but that's true for every investment. All right, turning to QOZs generally. So the concept of a QOZ, a Qualified Opportunity Zone, was part of the Tax Cuts and Jobs Act. And again, the idea behind it was to generate investment and economic growth in these low-income, economically challenged areas. So Congress, when they enacted this, they designated approximately 9,000 communities, which were eligible to be, or not eligible, which were treated rather as qualified opportunity zones. And sorry that the screen just went blank for a second. So then going through that, there's incentives that were created for taxpayers investing in the businesses located in these zones. All right, so here's a map showing an area, areas of qualified opportunity zones that were available, designated with respect to Florida. This information obviously is available, online. It's been updated. It is updated, but if you have a client who's interested in this, step one, if they're doing it themselves, is making sure that the investment will be in an area that is an opportunity zone. If you're investing in a qualified opportunity fund that already has investments, that's run by a third party, presumably that fund is, already done its legwork and doesn't need to look for this. All right. So again, first step is making sure that you find out where the opportunity zones are. All right, so the tax incentives that we talked about, again, and this is a little bit of a recap because we did talk about it before briefly, is the three incentives that we do have are we have a temporary deferral of capital gains if the gains are reinvested in the qualified opportunity fund. So again, I don't have to recognize them in the year that I normally would. I defer them until the 2026 year. And so that's one benefit there. One thing to note, and we'll talk about it, is that there's no guarantee what the capital gain rate will be. So you are running the risk that the capital gain rate might increase because you're going to be paying your tax on the rate in 2026, not the rate of the year when the gain otherwise would have been recognized. So there is that little bit of a risk there. Then you have the partial exclusion of previously deferred gains. All right, so again, that meaning to the fact of the step up in basis rules, the 10% and the 15%, that is very applicable for individuals that made investments in qualified opportunity zones prior to 2021 or 2019, where those periods are going to run before the 2026 year, because that provides them with some basis that they're reduces the amount that they otherwise would have to recognize in 2026. For other individuals, if they're dealing with investments that are made prior to that 5-year window, so say 2022 and on, if they are going to hold it for 10 years, there isn't a huge amount of benefit there of getting that basis because the gain's going to be gone anyway. And the increase in the basis is going to occur after the gain recognition in 2026. But it is still there. And then finally, the permanent exclusion of post-acquisition gains for a QF held longer than 10 years. That is your big winner for a lot of clients. They're investing in property, developing that property, expecting that in 10 years when they sell that property, it will have significant value increase and to not have to pay any capital gain or tax on that amount, obviously is a wonderful thing. So with that, what I'd like to do is stop for a minute for a polling question. And if we go to, it's going to take me a second to get there. I apologize to have to do it this way, but I'm not sure how else to do it. So we are going to go to polling question number 1. How familiar are you with qualified opportunity zones, QOZs? And letter A, very familiar. Letter B, somewhat familiar. Letter C, heard about it, but not sure of the details. And letter D, not familiar at all. So we'll give you a minute to go ahead and do that polling question. And then we will return back to our slides. Okay, so very few people are very familiar, which is good. This is a beginner level course. It'll be good to provide most of you with a little bit more of a background. Hopefully it will raise some questions for you and provide a few answers at least. But more importantly, let you know about it so that you can think about it in situations when you do have a client where it is applicable. You'll be able to bring it up, and then you can always do a little bit more further research down the road when you need to. All right. All right, so back to the good old jokes. Did you know that Shakespeare once made a performance about puns? And the joke is, it was a play on words. Man, these are fantastic. All right, one last one while we're here. What do people like to wear in England? T-shirts. All right, so back to the opportunity zone investments. Taxpayer realizes a capital gain, that is the eligible gain. So when you're looking at this literature or the tax code, anytime you see eligible gain, that's your capital gain. You have to reinvest that gain within 180 days. A QOF conducts a Section 162 business directly by, in 162 business, business for profit, directly by holding the business property or by owning an interest in a QOZ entity. So again, this goes back to that first page that we talked about. And hold on one second, I apologize. And in addition to that, we've talked about the holding interest for the 5 years, excluding 10% of the original gain. We've talked about the additional 2 years that you get for an additional 5. And again, on December 31st, 2026, you're going to have an inclusion event if the property has not been sold beforehand. One of the, so if the property is sold beforehand, then, we'll get to that, right? In the sense you're going to have an inclusion event. But if you recognize inclusion event on 2026, it's because you're still holding the property. And again, what you're going to recognize is that deferred gain, possibly with the subject to the 10% and the 5% basis adjustments, depending on your holding period. But you're going to recognize the lesser of that deferred gain or the current fair market value of your investment. So that's December 31st, 2026. So again, 2026 is when you're going to pay your capital gains tax, is the easiest way to think about it. You might pay a little bit less if you have the holding periods. Again, it's dependent on what the rate is, but basically you're deferring it until 2026. All right, and then again, assuming sometime between 2026, December 31st, and January 1st of 2048, so really January 1st of 2027, and January 1st of 2048, you have 21 years to sell your business. Assuming you do it during that tax period, there will be no gain at all from the sale for all of the profit. And that is your biggest opportunity to recognize a significant amount of gain and tax savings here. All right, so going back to the slides then. All right, so again, the reason for the incentive and the reason that we stress this is that it's very much like a smell test. I mean, the idea, if you're worried about if the business is going to qualify as a qualified opportunity zone business, you need to make sure you're within the spirit of the law. And the idea is to provide tax benefits, to provide for people that make cash investments in qualified opportunity zones, with the idea that they're going to improve the lives of the people living in the opportunity zone. So it cannot just be a passive investment providing no benefit in the community. So if passive investment, no benefit in the community, a simple example is I buy raw land, there is nothing but trees on there, and I do nothing to it. And then I go to sell that raw land later. That is not a business. That's not going to qualify. It hasn't done anything. So examples that are acceptable, again, if I bring a new business into the opportunity zone. So if I have a manufacturing entity or I have a manufacturing business and I create a new manufacturing center in that qualified opportunity zone, you're going to get some benefit there. And then engaging in projects to increase the value and availability of housing options. So the development of housing and items like that are going to work as far as that goes. One thing you need to be careful of, though, again, is that it needs to be an active trade or business. So if you're in a triple net lease, as a general rule, a triple net lease will not qualify because you're not active enough. If, however, you're the landlord, you're actively managing the units, then you're not really in the triple net lease world anymore, and you should be able to qualify. So there's more detail on that in the regulations, but just something to point out as we go through. All right, so again, you need to look at what the law doesn't allow, make sure you don't fall in that category. Main reason being, investor can't simply buy raw land. It's got to be an active business. And there is a list that we'll have later. The business can't be like one of the sin businesses is kind of the good way to think about it. You know, it can't be a business that is a vice or a sin. And then finally, there are some anti-abuse provisions, you know, to make sure of. But again, if you're going into this with the idea that the business, and you can think about it, and that the business itself is helping to improve the lives of the people in that qualified opportunity zone, and it's an active business, then so long as you're not one of those vice businesses, you're probably going to qualify. All right. So again, eligible gain is the capital gain for federal tax purposes, rather. And you're going to need to recognize the gain before January 1st. So again, by the end of the 2026 year, the gain's going to be recognized. It can either be recognized through a disposition event after you've made your investment in the Qualified Opportunity Fund, or if you still have that investment in the Qualified Opportunity Fund and there's no disposition event, then again on December 31st, 2026, you're treated as recognizing the lesser of the gain postponed or the fair market value. All right. And one other item to recognize is that for the gain to be eligible, and this is really important, the gain cannot result from a sale involving a related party. It's a 20% direct or indirect ownership's interest standard. Make sure you're aware of this if you are in a situation where you're trying to generate a capital gain and the sale is to anyone remotely close to being related to the individual taxpayer. Make sure you review this section to make sure that you qualify. It's not a gray area, it is black and white, but make sure you're aware of it, because you don't want to promise that it would qualify, have a sale occur, it's still going to be a capital gain that's going to be taxable, but maybe it's not an eligible capital gain because it's to a related party. And if it's not an eligible capital gain, now all of a sudden your client's paying income tax on that in the year that the gain was recognized, which is probably going to cause you an issue if you said that you could defer that. All right. With respect to 1231 gains, it's been clarified that the 1231 gains can now be invested in a QOF like a normal capital gain. And what's nice with clarification here is it's regardless of whether you have losses or not. So the 1231 gains can be invested in the QOF. They don't have to be netted against the losses. And if you invest those gains in the QOF, then what's nice is you still have those losses. And because they can be deferred, you know, then you get the benefit of the ordinary deduction in the year that you take that, in addition to having the benefit of deferring the tax on the eligible gain. So the combination of those two items is a nice little point that's been clarified with respect to 1231 gains. And so now looking at eligible gains, there we go. So dealing with eligible gains, if a taxpayer generates an eligible gain, they can defer the gain like we've talked about. One thing I'd like to do, just to point out real quick for those people that weren't, are not, and to go back a slide, I apologize, I'm bouncing around for a second. But to go back to 1231 gains, if you're not familiar, Section 1231 property, it's real or depreciable business property that's been held for more than 1 year. So if you're in a situation where you're dealing with the 1231 property, that could be a significant benefit for people. All right, so turning again to the eligible gain, if you have it generate the eligible gain like we talked about, you can defer it. So if you receive multiple payments during the course of a year, like on an installment sale, you can either have a separate 180-day period for each payment or have a 180-day reinvestment period at the end of December 31st. All right, so there are some timing things that are unique even for an individual taxpayer. They're especially more unique for a corporate taxpayer. One other item to note on the eligible gain is that item at the bottom, and it goes kind of to the related party exception like we talked about on the last slide. And that's for this situation, you cannot sell an asset to a qualified opportunity fund and then reinvest the gain that you just caused by selling the asset to the qualified opportunity fund. You cannot reinvest those proceeds into the same qualified opportunity fund. It can't be circular like that. So again, it's just kind of a logical answer. All right, so eligible taxpayers, Again, we talked about it. Individuals can be yes, can be a C corp, can also be a partnership or an S corp. It also includes trusts and estates. You know, a lot of people are not aware that it was eligible for trusts and estates as well. Far as partnership and S corporation goes, and this just goes towards the basis aspect for anyone that's interested in this technicality. Because the eligible gain is deferred, it's not included in the distributive share of the owners. Typically, your gain in a pass-through entity like a partnership or an S corp, you're going to have that being included in the distributive share of the owners. When the gain is included in the distributive share of the owners, that gain increases the basis of the owners, right? And again, typically it's in the year where the gain occurs. But in this situation, because the gain's deferred, you don't actually get an increase to the basis for the shareholder until that deferred gain is actually recognized in the future. That's the point where it's included in the distributive share. That's when it increases the shareholder's basis. So if you are doing additional tax planning for the entity, and you're worried about tax planning for the shareholder and recognition events for the shareholders, obviously the basis is very important. So just be aware of that, that if the shareholder elects, you know, with respect to that for the distributive share, or it's just a situation to be aware of and make sure you handle properly. All right, the timing of the reinvestment, again, generally it's 180 days from the transaction. There is some flexibility for partnerships and S corps. They can elect to start the 180-day period on the date that the tax return, not including extensions, is due. So it can be 180 days from the date of the event, or 180 days from the day that the tax return is actually due, not including extensions. So that gives you a longer time frame to reinvest the gains if you're dealing with a partnership or an S corp, as opposed to an individual taxpayer. When you are actually making or reporting, I should say, the investment, what you've got here is the form 8949. We just provided you the sample. You complete the 8949 and attach it to your tax return for the applicable year, and that is how you report the investment. With respect to the Qualified Opportunity Fund itself, so this is the reporting from the taxpayer standpoint. With respect to the Qualified Opportunity Fund itself, the fund also has to file and qualify. And there are some reporting requirements for that, which we will get to in a few minutes. So with that, what I'd like to do is go to our second polling question. All right, and second polling question: what type of investment are you most likely to consider in a qualified opportunity zone? Real estate development, small business, or startup investment, infrastructure projects, or not interested in investing in QOZs at all. And it's one point to point out is that A, B, and C, all three of those things would qualify. It's just more of a personal preference that we're just curious about from seeing the investments that your clients have, which is more likely, in your opinion, to be something that would be useful and handled with your clients. All right, so now I'm going to go back to where we were. And there we go. Okay. So the amount of the investment, the taxpayer can invest up to the amount of the gain as far as making it qualified investment and eligible investment. So if I have $1,000 of gain, I can invest up to that $1,000. If I invest $1,500, I've invested more than my 1,000. So maybe the first 1,000 of the investment would be treated as an investment in the Qualified Opportunity Fund, an eligible investment subject to the deferral and the other items, with the basis increases like we talked about. The other investment would just be treated as a normal $500 investment in the entity, just as if I invested in any other entity. It has nothing to do with the Qualified Opportunity Zone. There's no impact on that at all. So you're going to have two different, for tax purposes, you're essentially going to have two completely different investments. Right? turning to the next slide then, in 1 second here. There we go. All right, so as an example, if Mike has a $200,000 eligible gain on June 1st of this year, on June 30th, he invests $350,000 into the QOF, and he defers the $200,000 of gain. He's going to be treated as having made two separate investments into the QOF. The first is the $200,000 investment, which is the deferred eligible gain, right? So again, you're going to get the benefits of being in the qualified opportunities fund, qualified opportunity zone, just being part of this program. The second investment, the $150,000, that's just going to be treated as a normal investment subject to general tax principles. So there's no penalty for making an over investment. It's just you don't get the benefit of all the items that you would when you think of making an investment in a qualified opportunity zone. All right. So let's turn to the recognition of previously deferred gains. Again, this is the earlier of an inclusion event or the amount that was deferred will be recognized on December 31st of 2026. So you have your two different items there. As far as an inclusion event goes, again, the inclusion event would be a sale or other items. Some certain inclusion events would be, I'm just trying to find a list here. Hold on 1 second. I apologize. There are certain inclusion events that can be tax events. So if you had a distribution from a QOF partnership in excess of the partnership's basis, that's going to be an issue. Distribution of property from a corporation could be a inclusion event. Dividend equivalent redemptions, the receipt of boot, items like that. The other general rule, though, is that if the partnership interest or the interest in the QOF is sold by the taxpayer, that's your inclusion event. So the amount of gain recognized is calculated by subtracting the taxpayer's basis in the QOF investment from the lesser of, again, we've talked about this, the original deferred gain or the fair market value of the interest in the QOF as the recognition event. If you do sell an interest in the QOF that was previously subject to gain deferral, it's going to be a capital gain there. You do actually have 180 days. You can take that gain and reinvest it in another QOF. So you're not completely stuck. I'm not sure exactly from a practical standpoint why you would do that unless you were really concerned with the investment in the one QOF and wanted to make it a different investment. That would be the only reason, really, but you're certainly not going to generate a tax benefit from that. All right. So then again, going to the next slide, the attributes of the deferred eligible gain, when it's recognized, stays the same. Again, it's going to be, capital gain. It's treated as capital gain when it's recognized. The one difference is that you're going to be paying the rate that's applicable in 2026. So you don't know that. It's the one variable that is a little bit of a risk for you to consider as you're going through this with a client. All right. So next we go to inclusion events. Other inclusion events besides what I talked about would be a termination or liquidation of the qualified opportunity funds. The owner of the qualified opportunity fund, if it's corporate, being liquidated. Important to note, transfer an interest in the QF by gift is an inclusion event. It's not by death, but by gift it is. And that's interesting to note because it certainly could be an issue between husband and wife. I mean, we don't think about it typically from husband and wife filing, say, a joint return. You don't typically think about a transfer between the two of them as being an issue from a tax standpoint, but it's something that I know is at least a potential issue. It's something that when we looked at before transferring an interest from a husband's living trust to the wife's living trust, we were not comfortable doing that because we thought it was going to be a liquidation or cause of distribution event to have occurred, or an inclusion event rather. So again, it's a trap for the unwary to just be aware of. And then also, if you do have a S Corp taxpayer with a QF investment, If it converts to a partnership or a disregarded entity, that conversion's going to be deemed to be an inclusion event causing the liquidation. All right. And if you either, doesn't matter, if you decrease your interest in the investment or, if you cash out entirely, it could be a partial inclusion event. But those are the items to look for. And again, the main one on that list that's unique, or at least was to me, is the transfer of an ownership interest by a gift. All right. Non-inclusion events, again, generally, if it's transferred at death, for the most part, that's not going to be an issue. If it's transferred to a grantor trust, provided the grantor is paying the income tax on the trust. So this is where it would be an exception to a gift. Where I was saying gift earlier, I meant like a gift outright to my spouse or to another individual, like my kids. But if I transfer the ownership interest, even if it's a quote unquote gift, to a irrevocable trust that I'm the grantor of, and I've retained certain powers over that trust, like the ability to swap assets for assets of equal value, then that trust is what's considered to be a grantor trust for income tax purposes, meaning that I own that trust for income tax purposes. And because I own it for income tax purposes, any gift that I make to that trust, it might be a reportable gift for gift tax purposes, but for income tax purposes, it is ignored. And that's why funding a grantor trust, even if it's funded with a gift, is not an inclusion event. Then we get to the transfer of a QOF interest to a partnership in exchange for a partnership interest. So again, if you're in 721, you're dealing with a tax-free exchange there. You're not going to have an inclusion event. And then making or revoking an S Corp election as well. All right, so inherited QOF interests. All investments of deferred gain have a zero basis initially. Then you can get that 10% or that 15% step up. Because of that rule, this is a unique asset in that 1014E doesn't apply. So the basis in the QOF does not get adjusted to fair market value on the death of the individual. The death is not an inclusion event. So instead, the heir inherits the investment with a carryover basis equal to the basis the taxpayer had in the investment. So it's similar to like with, when you think about like your IRAs and things like that, the assets that are in there don't get stepped up. And so you have that same situation here, that if you inherit an interest in a QOF, you're going to have carryover basis. You're not going to have a step up. You're not going to have an immediate recognition event, but it's just saying that if you end up selling that property, your basis is the same basis that the decedent had. You don't get a step up in basis to fair market value. So unless you're selling it if you're selling it in a situation which causes an inclusion event, then you're going to be in that same situation as the grantor would have otherwise been had he or she not died. All right. So as an example, Pam contributes 100,000 to a QF in exchange for an investment in January 2023. It was capital gain. 100,000 was excluded from her gross income, and therefore her basis is zero. If she dies in 2024, 1 year later, then Bob's basis is zero. All right. If we modified this, and let's just say that I had it that in January of let's go back 8 years. So if in January of 2016, Pam had contributed this 100,000, then after 5 years, so in January of 2021, her basis would have increased to 10,000 in the investment, that 10% rule like we talked about. And then in January of 2023, which was 7 years after the original contribution in my modified example, her basis would have increased to 15,000. So in that situation, then if she dies in 2024, Bob's basis is 15,000, not zero. The most important thing is that Bob's basis is never 100,000. There's no adjustment to the fair market value on Pam's death. All right. So qualified opportunity funds. So the QOF is an entity that achieves the policy goal of actually investing the funds and bettering the lives of the people. That's the way to look at it. It can be existing as or organized as a corporation or a partnership. It can either be newly formed or pre-existing. It does not need to be physically located within the QOZ, like as far as the incorporation goes. You know, it's fine that it's incorporated outside of the QOZ. And then to qualify, again, you have to, as a QF, you have to file an 8996 each year. It's an informational return. In addition, you know, with the tax return, it lists out the assets, and it also shows the IRS that you qualify as a QOF. Now, for the first year filing, if you're dealing with an entity that is a pre-existing entity, the first year that it wants to be a QOF, it needs to elect this on the Form 8996. What's important about that is that anybody that made an investment before that election is effective, that investment is just a normal investment. It doesn't become an investment in a QOF because the entity elected the QOF status. The entity has to elect QOF status first, and then after that election is made, then subsequent contributions or subsequent investments in that entity will qualify as QOF investments. But again, it doesn't go retroactive in that if the entity makes the election, it's only the investments after that election is made that qualify. Any prior ones are just treated as normal investments. All right. So 90% test, when you're looking at the QOF, at least 90% of the assets that it owns have to be QOZ property or QOZP. So QOZP, QOZ property, all right? And to determine that, you take the average of the assets on the first day of the 6 month, or last day rather of the 6 month of the tax year, and the last day of the tax year, right? So if we're dealing with a calendar tax year, you're looking at June 30th and December 31st, and looking at those and the averages of the percentages to see if you qualify. If you don't qualify, you know, there's going to be a penalty for each month unless you have a reasonable cause exception being met. So one item of concern that could be for people, especially for entities, rather, especially startup entities, is making sure you qualify for this when you're receiving cash donations, and some of them could be large, etc. So you can exclude from the asset calculation. So basically, it means you don't have to count, right? That's the the very simple way of saying this is you don't have to count. The more complex way of saying is you may exclude from both the numerator and denominator of the asset calculation. It's just written by a math teacher, it sounds like. And it's not me, I'm not a math teacher, so you shouldn't be writing that way. I always think back, not to digress totally, but you know, when I was in law school and we had our legal studies, and the professor would always say that if you could write something in a sentence, why would you ever write it in a paragraph? And if you could write something in 10 words, why would you ever use 20? I should have thought of that when I put this together. So instead of a QF may exclude, how about we just say for a QF doesn't have to count an asset if it was received in exchange for a membership interest during the 6 months prior to the applicable testing date. So that means that if I have my testing date as June 30th, if anybody makes a contribution from just January 1 through June 30 of that year, that contribution doesn't need to be counted towards my assets and whether I satisfy that 90% test as of June 30 for that year, right? Because it's the 6 months prior. The caveat on that is I have to keep it in cash, cash equivalent, or debt instruments. So I can't take the cash, invest it in the stock market, etc. If I do that, then it's going to be countable. But if I receive a cash donation and I've left it in cash, then I don't have to include that if it's within 6 months of my testing date. And so it makes it a little bit easier for the organization to qualify and not have to worry about receiving a large donation at a future time and having an issue. All right, so with that, I'm going to go to my third polling question. And these are getting easier and easier. Would you like to sign up for our Thursday Report newsletter? Yes or no? Thursday Report newsletter provides an attempt at humor, which is very similar to what I've attempted to do today. I'd leave it to you to decide if it's for better or for worse. But in addition, we also have articles that are timely on different topics. They're written by the attorneys here, by our the great law clerks that we have, and also by other individuals, other attorneys, and other professionals in the field that we deal with who have something of interest. And so it's a great resource for a lot of people. If you are interested in receiving that, let us know. We'll be happy to send it to you. All right. So going back, we just covered the 90% test, and we talked about the 18 months and the exclusion. All right. So qualified opportunity zone property. Again, it can be three main things. I can either have the business property directly owned by the QOF. So if my QOF is directly conducting the business, my QOF is is a car wash, and my QOF owns the car wash, and my QOF is buying the soap for the car wash. So there we go. That's QOZ business property, right? The other option is that the QOF invests in a business that is the car wash. So an LLC or another entity is formed, which generates and runs the car wash, and the QOF rather invests in that entity. And then that gets you that QOZ stock or partnership interest like you see there. All right. Turning to business property, again, it goes to satisfying the 90% test. We're only talking about tangible property used in the trade or business as far as what can count. It has to have been purchased from an unrelated party after December 31st, 2017. And the original use of the property must begin with the QOF or the QOZB unless it's been substantially approved. So again, the original use needs to start. That's one of the more important items. The other two items are pretty self-explanatory, right? I mean, it's got to be tangible property used in the business, and it has to be purchased from an unrelated property or unrelated person. So to qualify here, what we're looking at is that to substantially improve something for raw land, you've got 30 months to develop it. But the improvement has to be substantial. So you got 30 months rather to develop your car wash in my example before. All right. And I mentioned how a pure triple net lease is not going to satisfy the trade or business requirement. So going to the original use requirement, which again, I think is the one that's the most unique here. It's easy if it's never been used in the QOZ before, right? So you buy new property, it gets installed in the QOZ. It's a first time intangible or first time original use. If you're dealing with tangible property, original use is considered to use when the property is ready for depreciation or can be taken for depreciation. All right. A unique little wrinkle on its original use can be satisfied if it was placed back into service after it sat vacant for at least 5 years. And the 5-year period could be reduced in certain situations. But the most likely situation is that you're looking at substantial improvement. So, you purchase a building that already is there. You need to substantially improve the building. It's not sufficient to just take over the building. So as a general rule, kind of like as a safe harbor, the adjusted tax basis of property has to double during the 30-month period. That's going to get you to that substantial improvement. During the 30-month period that it is being improved, it does qualify as that QOZB property. So it gets you towards that 90% limitation while it is being improved. And then you can improve the property also, and this is unique, by purchasing property that improves the functionality of the first property. In the sense, so if I have property that I buy original other property and I install it, it increases the functionality. That's going to increase substantially the functionality of that non-original use property. So it is an area just to make sure you're familiar with and that you're able to explain to your clients. All right. So an example, if the QOF acquires land in a building on January 1st for 12 million, 2 million basis in the land, 10 million basis in the building. They were previously located in the QOZ. They don't satisfy the original use. And then if we say that they begin to improve the building, and during the 30-month period, they add 12 million of improvements to the basis of the building, then they're obviously not going to have an issue because the entire amount of the basis doubled. All right. Lease property can qualify. Lease has to be arm's length. It does not need to satisfy either the original use or the substantial improvement for the property being subject to lease. We don't have to worry about those tests. There are additional rules if it's between the QOF and a related party. Some of those are listed there. So again, if you are dealing with a related party, be aware that it's more restrictive. It shouldn't be a surprise of anybody. All right, so stock in the corporation and partnership interests. Again, this is just kind of explaining in a different way how they're going to be qualified for the 90% test, assuming it was purchased on or after December 31st, 2017, and issued for the right purposes. All right. Okay, if a corporate or interest and it satisfies the requirement, then all the assets of the subsidiary are considered QOZ property for the purposes of satisfying the 90% test. There's no prohibition on investing in pre-existing corporation or partnership if it satisfies the requirements stated above. All right. So the actual business, you need to operate a business. You can operate it through a subsidiary. That's fine. The subsidiary has to meet the definition of a QOZB, a qualified opportunity zone business, 90% test like we talked about. One other item to note, though, is to be a QOZB, the subsidiary can satisfy a 70% test, makes it a little bit easier to satisfy. 70% of all the tangible property owned or leased by the QOZB. And so by having my business in a QOZB, as opposed to directly through the QOF, that 90% standard can be loosened to a 70% standard. So the 70% standard for the actual business. And then if that's the only investment that the QOF has, the QOF standard is going to be met with the 90% without an issue, because it's all in there. So again, it's just something to be aware of, that you can have a smaller satisfaction requirement with the subsidiary setup. The subsidiary shouldn't be disregarded. Go ahead and consider having other family members or other individuals invest in the subsidiary, so that the subsidiary is more of a partnership, not really 100% wholly owned subsidiary. And that'll work out well. All right. For each tax year, QOZB has to satisfy requirements. Those are laid out here. In the interest of time, I'm just going to move past them for the minute. I do want to just talk about, well, one of the requirements is this, like you see, 50% of the gross income. So looking at that, 50% of the QOZB's income has to come from within the QOZ. So there's safe harbors to meet this requirement. At least 50% hours of employees and independent contractors are within the QOZ. 50% of the amount paid are for services rendered within the QOZ, or the tangible properties located in the QOZ and management and operational functions are necessary, generating 50% of the income. So that's how you satisfy your income test. The non-qualified financial property test needs to be satisfied as well. And then more importantly too, at the end, the disqualified business test. This is our SIN test that we talked about. You can't have a private or commercial golf course, country club, massage parlor, hot tub facility. That's too bad. I mean, down here in Florida, technically that could close half of our beaches at this moment. So no QOZBs on the beaches during the summer. Suntan facility, same thing. Racetrack or other facility used for gambling, or any store, the principal business of which is the sale of alcoholic beverages for consumption on the premises. All right, so those are ones that, regardless if you meet everything else, you're not going to be a QOZ and have the eligibility. So again, you have the eligibility of the game, the 10 years, or the 10% deferral, 5% deferral, and after 10 years, you have the 100%. What we're going to do is we're just going to run through one hypothetical here at the end and conclude. But before we do that, we will finish with our fourth polling question. Would you like to become a beta tester for our new estate planning software, Estate View? And you can click yes or no. Quick note on the Estate View, it's a software program we've developed to help you with your calculations for the various estate planning that you have to do, determining what the rates are for skins, private annuities, Cuperts, grats, all kinds of good stuff. It also helps to run out projections showing you what the economic benefit's going to be, what the economic impact on your client's going to be. You've got explanation letters, charts, and graphs. It's interactive in that you're able to move sliding bars or put in the information and everything adjusts directly. And perhaps more importantly, and it's something that we're thinking about doing here on the webinars, but we're afraid that you're never going to come back, is that we are putting a feature in there, which you can press the button if you need an automatic 15 to 30-second reprieve. It'll click you over to YouTube and you'll get some comedy, some good comedy, hopefully. So getting in line with that before we do get to the last example, what's the largest export of Great Britain? And the answer, Independence Days. So that one made me laugh. And what is the favorite day of every person in England? And the answer is summer, because they only have it for one day. So I think that was all the jokes that I had. All right, so what we will do is in the last couple of minutes, I'm just going to end up with a hypothetical. So on May 19th, May 1st, John sells stock, basis 2 million for 3 million, realizing $1 million net of eligible gain. July 15th, he invests $1 million QOF. What are his tax benefits? So the first thing is May 1st to July 15th. 2019, he's well within his 180 days. He did sell it in 2019. So he's going to elect to defer the recognition of the $1 million. So again, he takes that $1 million and he invests that in a QOF. And in my fact pattern, he did that on June 15th, or July 15th rather. So he's well within that 180 days. All right, so 2019, he's not paying any taxes. He doesn't have to pay any taxes at all until 2026, assuming that there's no inclusion event. If there is no inclusion event, that's when the taxes are going to be paid. Now, again, he has zero basis as of 2019 because he's elected to defer the gain, right? Now, that zero basis is continuing for 5 years. In 2024, May 1st, 2024, 5 years. Well, actually, that's a typo. I apologize because the investment, it was not May 1st. It was July 15th, rather. So it should be July 15th, 2024. 5 years later, he's got that investment in there. Now he gets a 10% deferred basis increase. So his basis increases to $100,000. Again, that's 10% of the original $1 million. And now that's what his basis is. So if he has a inclusion event now as a result of a sale, he's only paying tax on the $900,000 of gain, not the full $1 million. If we wait 2 more years, again, the same typo, at least I was consistent, I apologize. Now we're up to 15% total, an additional 5%. So he's got a gain exclusion of $150,000. $850,000 would be subject to gain. Now, when we get to December 31st, 2026, he has to pay tax. The amount is going to be, in my example, the lesser of $850,000, or if his $1 million investment's only worth $500,000, he pays tax on that $500,000. All right. If you hold the investment past December 31st, 2026, he's got to pay the amount of gain. In this example, because it's increased, it's $850,000 of deferred gain. All right. Then after that, in 2035, he has a basis of $1 million. That's the basis after December 31st, 2026. 2035, he sells the investment for $9 million. Because it's been held for longer for 10 years, there's no gain that needs to be recognized. All right, so with that, we've reached the end. This is kind of my conclusion slide at the end, summary, which I think you'll find self-explanatory. I want to thank everybody very much for their time, and I appreciate everybody's attention. Hope everybody enjoys the rest of your day. And in honor of Alan, like always, got to do the sign off. May the rest of your day be billable. Thanks very much. Have a great day.